He's trying, but seems Discord is not being very helpful this morning. Yeah, Sean, as brilliant as he is, I took us years. I think many people sent him likes, and he doesn't like to talk. He's a typer. But I had the privilege of speaking to him one-on-one last night. And when he speaks and explains things, it just clicks.
Hear me here?
There it is. I can hear you, but there's an echo. But everybody seems to be getting an echo today.
I'm gonna get this speaker on.
There you go.
But let me see.
Well, good morning.
I can't work my phone worth a bean. Like, this is just utterly ridiculous.
I know.
I have no idea. I can talk. I can't hear anybody, but I'll just talk through it. It's like I can't figure out how to get the speakerphone on. All I want's a flip phone. I don't want this stuff. This is retarded. Okay. So, anyways, what we've got going on, hopefully you can hear. We go into Spread Monster. Well, the first thing is to start this whole process. So this credit spread, this whole process starts with an idea, a concept. And what we're doing is we're trying to figure out a trade. And to figure out a trade, there's only one thing we need to do is figure out a line. That's all we've got to do. For a credit spread, if we can figure out a line, then we've got a trade and we can make money by Friday. So this idea, this concept is to figure out a line. So it starts with a line. So we need to find a line somehow. If we can find this magic line, And you saw what happened when we found it last week. If we can find that line, then we can make money. And we can make money every week if we can find this line. So the way I go about it is, and the reason, Spread Monster's been set up the way it is we have several points of information. And the one point of information is these purple X's. And in order to set this up and do this, you must do this. You have to do wave one daily and use whatever symbol. Here I'm using QQQ. You absolutely must do it that way. And there's other fancier stuff we can do, but for this Monday through Friday spread, it must be done with this. Because what we're trying to do is we're trying to teach Spread Monster what the movement is up and down, what its margin on an SPM. So we're trying to teach it the margin, the resistance, and the support. And if we can teach it that, then we have a shot at finding the line. So the first thing is these purples, those little purple X's, I go in and measure them in Spread Monster. And this gives me the density. Here's the purple X's. I know at 9:30 a.m. this morning, our highest shot of opening, our highest chances of opening is in this purple range right here. We can open in the center. Last week we opened about in the center. We can open on the lower end. We can open on the top end, anywhere in here. But that gives us a range. That gives us an idea this morning where we're going to be. And this technique, it doesn't rely on that much precision. That's why we can do it this way. We just need an idea, the concept of where the price can open this morning. And here's this little purple. This is where on an outlier it would open this morning. You can see we're on the lower end of the purple. So it's opening within the nominal values. It's opening where we anticipate. Now, going back to the idea of the line, finding a line, I found my line. This line is the white line right here. So that's my line for this week. Just like last week, I showed finding my white line. And, the market went and touched it on Monday morning, never revisited it the entire time. Just Monday morning, came in contact with it a little bit, zoomed up away from it, and then we continued moving along. So the way I find this line is, so we've got our purple opening blocks for our density. We're looking at where the highest density, it's really hard to see it on the screen, but we're looking at where the highest density is, and it's right here up to right there for my purple X's. You want to see them overstricken, and you want to see them all smashed together. Now, if I go over here, I'm defining where they're at and how they're clustered. So I see a group here, and then I see a group. It's easier on the screen when the spread monster thing's up. I see a group up here, and then I see some stragglers up here, and then I got a bunch of little one-offs up here that I really don't care about. So what I did was I took these purple boxes, I've got 3 of them defined. I moved them over here. 1, 2, 3. Maybe I broke them up into 4, but anyways, I've got whatever number of purple boxes, got 4. It doesn't really matter that much. Like we're playing horseshoes. So what I'm trying to do is just find the volatility over here on the close side. Let me try to get more. Maybe I did this. It's like kind of hard for me to see. Up here, I know I did that. Got that. So anyways, I came up with 4 right here. I labeled them. Highest density. Density, we're looking for overstrike. And what that means is when the X's are coming in and they're getting knocked out like this, these are our close prices right here. We're overstriking, we're creating density. Market likes density, this. And then we're seeing gaps develop. So that's what's leading me into drawing these boxes like that. And then I bring them over here. So I'm creating my zones. That leads me into my white line. I got to find the white line. I'm babbling about the white line. So what I'm doing is I'm looking at my density over here that I've come up with visually because I like to see it. I don't care for somebody telling me something. I want to see it. I don't want a computer spitting out a number 5 and then I use it. I want to see this because I want to see what I'm up against. I want to see if there's more closing price action calculated down here. What's up here? I want to see this because I want to be in control making the decision. I don't want somebody else telling me what to do. So these prices, all this is doing is taking the historical volatility and putting it into this waveform, this sinusoidal waveform. And it's taking the historical volatility, it's putting it into a waveform that I can more visually see. You can see it's kind of a noise pattern. And then it's projecting it forwardly. And then it's projecting the X's, the purple X's. That's the open based on historical movement. The purple X's on the far right are the close. So these are the 9:30 a.m.s here. These are the 4 p.m.s here. So this is Friday here. This is Monday here. So I put that on. We're seeing in real time how it's working. Our price action is exploring this area. It's coming down near the bottom at 9:18 a.m., which is good. We're falling within the nominal range. We're falling into what's anticipated. Here, we're coming into this area down here. I'm able to, since I'm taking what I'm keying in on, what I care about is Friday, where I'm at Friday. So I'm coming over here and I'm caring about Friday, where we're going to close. And I see this red line, downside risk, and then we've got outside move. It's already calculating for me. Spread Monster, it's saying, you know what? When we get down below this red line, there's a risk that we may lose it and we may never return up here. Okay, so when you're looking at it, I put in my red line. So, Spread Monster is helping me. It's guiding me through this. I just need to know what to look for. So I look for my red dotted line. I look for my green dotted line, which is Friday's close. And I look for my solid green line, which is the outside move, which is up here. So it's like, this is basically defining a nominal range for the week. And then if we move beneath or above, depending upon how we're positioned, we make all that much more money, or we keep whatever bet we've got on during the week. But Spread Monster, it's showing the red dotted line, the green solid line, our dotted line from Friday. So here's our dotted line from Friday. That was our close. Here's the red dotted line. Here's the solid green line. Above solid green's an outlier. Below the dotted line's an outlier short. I've got my closes over here for Friday, where the market tends to have the density of outcome. This is the highest density right here. I marked that so visually I can know. Just because I had the most X's all jammed up in here. So that's the range, the top, the bottom of the range. We had a small outlier up here where we do have some X's marked showing the close price calculated out forward in front of us. And then we do have a sometimes area down here. So sometimes an outlier we get up here. Sometimes if we're mildly bullish, we're here. And then if we're just really bearish, we're down here. So this is not often. So I'm taking my white line and I'm putting it above my not often. On Friday, when we get there, and we'll see this Friday, what we get, if we're above this white line and we're above our not often close for Friday, then we win. Here's the credit spread. We're selling 601. The white line's down here at 601.18. So we're selling right underneath the white line for the credit. That's the first part, the 601. Here's the 601 put. So on Friday, where were we at? 453 was the last close. I don't know, 415 when it showed, but so it was right up here on the close. We were in the $400 range on our put. So here's the credit, and then we come down here at the 596 and we buy our insurance. So 596 is underneath the white line. That's our insurance. That protects us if the market went to zero, right? Something really bad happens, it goes to zero, we're protected. So we only have a 5 width of risk. That means wherever we enter, we subtract $5 out. So here's our red line for our guide of entry. Remember, we always put our red lines heading into zero. The objective for the writers, the sellers, is to go to zero. So we put our red line down into zero at expiration for 4 o'clock, basically, on Friday. This is the action line. When we get to this red line or above, that's when you put your trade on. Now it can be really fast. What I'll do is I'll pre-put trades into the system. I'll put them into the queue. So they're hanging out in there and they're working GTC and they're hanging out ready to hit. You can see we're underneath. We wicked up to it a little bit last Friday. And of course, knowing all this stuff, knowing these purple lines, technically you can put this trade on Friday and let it bake in the oven until this coming Monday. But for these purposes, we're going to say it's a Monday through Friday trade. So what we want to do is we want to wick this red line. When we get to the red line, that's when we put the spread on. And that's the spread right there. It's the 601 from the 596. Now you see where we wick through it? The more you can get up here, the better. I mean, this thing went to 400, four range. That means if it goes to zero, for every spread we put on up here, we keep $400, 400 plus. So the higher price you get in here, it has to obey this red line, but the higher price you get in here, the more you make. So let's say you put 5 of them on up here at the $4 range, it's $2,000. So you're trying to keep that $2,000. And the way you keep the $2,000 is to have this go to zero. Now you can see, and you can see last week, as long as we're over this support vector, really you have a fair shot at coming out with a gain. So, if you're just impatient and you can't wait for the red line, or let's say we never did touch the red line all through the week, as long as you're going above that support vector, you have the potential to make money. Not that great. I mean, it's $39 here. So you got to pray that you're going to absolutely wipe out so you can hit that, keep your $39. So you're better off getting, in the $2 range plus, ideally. Now, we're watching the put, we're watching a call. This call can work. See this purple over here? If we're in this zone here, I put on there the 611, right here, 611. So here's the common zone to close in, the highest density. Doesn't mean it'll do it this week, but that's where it's been closing over the sample period I looked at. So if we close in this zone or above, then we're going to be at this 611 line right here, this $2 line and above. Now, that means if this thing's following that red line, there's risk of it going to zero, because let's say we weren't at the 611 and we were underneath, which we do have a case here for it. We do have a case here for it. So this is a long call, you'd be buying it long if you're so inclined. And, the objective is if you're buying it under that red line, you better hope and pray that it gets above it and we get a close. Mathematically, this is where it has been occurring, but it doesn't mean it has to do that. So this, again, going back to the spread, I'm all over the place, but going back to the spread, which is this white line this week for me, and the rationale again is I'm going right above my least operable close prices for this week. Spread Monster's calculating them out for me. So again, I'm coming over here and I'm seeing my lower prices right in here. So I'm putting my white line right down in there. I'm putting it right above that zone right there. So, you know, you pull up Spread Monster Wave 1 daily. This is a high-low matching. There's an issue with it now. It'll be fixed during this week. So this is high-low matching. So it's finding the wave pattern for us, and we're trying to exploit that. And it's showing our close prices based on that wave pattern. So again, I'm coming above the outlier close for Friday. So I have a good potential. I have a very high potential for keeping this money for Friday. As long as we stay above that white line. It's like the market's about to start here. So we'll see. So what, you know, again, what we'd want to do is put that on when we get up to that red line. And it's anytime during the week. There is a risk. So I did this risk assessment. So based on Spread Monster, following these sinusoidal waveforms, these things here up and down, there's a case that if we come down into Monday, Tuesday and hit a low, we can be back up here. If we come down here Wednesday, Thursday, or Friday, there's risk that will close underneath. So if we're down here Monday, Tuesday, the trade can still work out, so you don't panic. If we're down here Wednesday or Thursday, underneath that white line, then we panic. Now there's a query we run. It creates this orange line. When we look back over the last 2 years, when we open today, whatever the open price is today, if we take 10 points out of it, 80% of the time over the last 2 years, we've maintained above this orange line. So we've got another confluence done a totally different way coming out of the data warehouse to show us what that looks like. And that is, that's this other graph I posted right here. So 80% of the time, if we take off 10 points, that zero is open. If we carve off 10 points, 80% of the time, we're always above that. And then here's the open line for Monday. And you can see that, you know, we do wick down in there. So it's very important that we do hold above that orange. That's kind of a line of last resort. And it's very ideal if we hold above the white line. Again, the white line's just on top of that lower outlying cluster I found for close prices Friday, 4 p.m. And Spread Monster, it shows this. And what you do is you just go in and do this over and over each week. And you can do it for the day. It works for the day also. So it's just not a weekly thing. You can calculate it out on the daily contracts also. So you can do the same technique on the daily contracts. And the reason we're doing a credit spread is because the market overall is too long. So we're trying to take advantage of the naturally occurring market, which is overall long. Okay, so our spread's right down in here right now. So again, we really prefer to put the spread on when we're up in this zone here. Got to be at this red area.
Not recommended, but I went with a 599, 594 for $1.15 just now on the open. And I'm looking to cut at 50%, right? Now, that's opposite of how Russell trades. Russell trades for zero. and he's looking for a much better entry than that. But I like to get my feet wet. And that's for educational purposes.
So the ideal thing is if our price action wicked down into this red dotted line, and that would raise the volatility on this, and we could probably touch that line up here. This isn't a bad price. It's just there's more ideal entry area.
Can you hear me, Russell?
Barely. I can't figure out how to get my microphone on.
I know that's your kryptonite.
It's
So
like I can barely hear. Like I don't know how to turn it on. I don't know.
I went with a little bit less aggressive off the open. I did a 599, 594, so still the same $5 risk. I got it on the open impulse IV spike, right? So I got it for $1.15. So in that case, my risk, okay, is $385 to make $115 if you take it to Friday zero. Now, ideally, my first target would be to collect 50% of that. So if I'm getting into like the 50 cent, 55 cent, I might take it off. Now, Russell will do exactly the opposite of what I'm telling you. He's going to say, well, hey, we're going to wait. We're going to wait and see, right? So there's different ways to play it, and I want to show you different ways to play this, right? So if especially if you have multiple contracts, so you should always start with one, and this is for educational purposes. You want to start taking a few off, and then have your runners. But um, ideally, if I can get this on a Monday or Tuesday, me personally, I take it. But the theory of this trade is every single day, theta will come off as long as we're away from it. So you have two ways to have your premium go against you and for you. Well, yeah, two ways, theta and delta, right? So every day, if the price is exactly the same, the contract will go lower because now there's less time for it to finish its course, right? So there's less premium for it, right? So that's number one. Number two is the delta. So I don't know what these deltas are, but let's just say it's a 10 delta. So every dollar it goes up, the premium should go down 10 cents, right? If it's a 10 delta, and the delta constantly changes, correct? As the price moves. So there are two ways for you to benefit from this, right? Ideally, you're looking at that graph. We're not at the red line. Ideally, that's your entry. Okay. Your entry is that we push up into that red line. Okay. And as you can see over time, it's descending, right? Because the sooner you do it, the sooner you get there, you have more time. Time is paying you for your risk, correct? So as time goes away, there's less time risk. Therefore, you get less reward, right? Less premium. So that's one of the reasons why I made a calculation. I said, I'm happy with this amount of premium. I had my orders loaded at the open and I went for it, right? But each his own. What would be really ideal is we go back, we touch that white line, you're getting $2, $3 for it, less risk, more reward, better turnaround situation. I'll let you continue, Russell.
Okay. Yeah, I wish I could get my phone on speaker. I can barely hear you. Maybe people.
No, I just covered the trade. You carry on with the tech.
What we're doing is, we're just kind of hanging out, waiting for the red line, see if we get it. Could get it anytime during the week. May not get it.
If you're new to spreads and you're using Thinkorswim, here's a great thing that you can do. When you enter a transaction, right? When you enter a spread, put a line on your QQQ chart so you know approximately what price QQQ was when you got that premium, right? And then as you watch price go to the same spot, you'll see how much different the premium is over the course of the week, right? That will help you understand better time decay for beginners. So, for example, this morning at QQQ at 9:31, I got my entry, right? So on a minute chart, I'll put a line in at 9:31 on QQQ. Now, tomorrow, if the price is at that same level, I'll see, well, do I still get $1.15 for it? Or do I get $1 for it now? Then you know, hey, look, in a day, 15 cents comes off, right? Now, premium is several factors. Time is one, okay? Distance is another, okay? And volatility, right? So if there's you know news or events in the market, well, if there's more uncertainty, you should be paid more for absorbing that risk, right? So that's your IV, okay? When you have uncertainty, when you have velocity, these are things that will come into your IV. This could then make the spread worth more, okay? Which is what you want when you want to sell, but not when you are in it, right? So I hope that helps.